Hey investor friends, I'm Michelle Markey, and today I'll share my key takeaways from Alibaba's fourth quarter 2021 earnings results, which unluckily for them came out before market open on Thursday, February 24, 2022, which was the same day that sadly Russia officially attacked Ukraine, and that sent markets tanking, so much so that the Nasdaq was briefly in bear market territory and the S&P 500 was 14% off its all-time highs, well into correction territory. But since then, these indices have regained those losses from Thursday, whereas Alibaba is still pretty much down after having tanked to a share price of $100 per share on Thursday morning. And since then, it's recovered about $7, so maybe it's around $107 per share at the time I'm recording this. And with all this in mind, we can see that Alibaba is still growing, but growing at a slower rate amid a slowing Chinese economy with reduced consumer spending and also some real estate debt issues. And amid all of this, we can just take a look at how Alibaba is still trying to truck along in spite of a lot of headwinds. And although none of this is investing advice, I'm not trying to recommend anyone buy or sell Alibaba. This is just for our investing learning purposes. So if you also enjoy learning how to study businesses, I'd love if you could please like and subscribe to my video and YouTube channel because I greatly appreciate it and it goes a long way with the YouTube algorithm. So let's get into it. If we take a quick look at Alibaba's high-level financial performance, we can see that they've been underperforming according to Wall Street's expectations on their earnings per share and revenues over the last several quarters. And by looking at their fiscal Q3 2022, that's the same thing as calendar Q4 2021. So I just added that to make it a little bit more clear because I like going by calendar dates, so it's a little bit easier for me to understand and track back to their previous performance. And then in addition, I noticed that their total revenues only grew by 10% year on year from December 2020 to December 2021. So that's not good, but their overall 9 months ending December 2021 was up by about 22%, which is in line with the CFO Maggie Wu's expectations of revenue growth of between 20 to 23%. And then their cloud revenues only went up by about 20%, and that's down from the previous quarter in Q3 2021, where they had performed at 33% growth in the cloud revenues. So that's also down significantly in my opinion, as well as their adjusted EBITDA is down 27% because of a number of their investments in various growth segments. So that can be explained, but it doesn't look that great right now if you just take it at face value. And in reading their earnings call transcript, I gathered a few noteworthy highlights from the CEO Daniel Zhang, who said that in China, their annual active consumers or AACs grew from 953 million to 979 million, and they're on track to deliver 1 billion AACs in China by the end of their fiscal year, which would be March 2022. So that's a good sign. And then he said when they reach this 1 billion figure, they'll have basically captured the majority of the consumers that have substantial purchasing power in China, and that's basically 71% of the population. And he said that once they do achieve this 1 billion mark, then they can shift their focus from new user acquisition to user retention and also growing the average revenue per user. And their retention rate of the new AACs was 86% in 2021, and also the ARPU or average revenue per user was $1,583 annually, which breaks out to $132 per month. And I find that impressive because I don't even spend that much myself on a monthly or average basis with e-commerce websites. So I'm pretty impressed that the Chinese consumer base seems to be holding steady and growing in their expenditures online. So that should benefit Alibaba in the future. In spite of some of those positives, it looks like Alibaba's financial performance will continue to face a bunch of headwinds that include macroeconomic factors, regulatory pressure, increased competition, and slowing consumer spending. And some of the macroeconomic factors include how the Chinese economy itself is slowing down. After its GDP grew by 8.1% in 2021, it only is projected to grow by 5.1% in 2022, as well as China's debt to GDP has never been higher at a ratio of 67%. So it's also a bit of a warning sign because a lot of the depressed real estate property issues going on are weighing on consumer spending, and that's ultimately going to affect Alibaba's earnings and revenue growth as well. And so if we have increased competition from the likes of Pinduoduo, Kuaishou, and others, that's also going to hamper Alibaba's core commerce businesses, as well as with regulatory pressure. We're not sure if that's going to lessen up from here on out. So the two things that Barron's article mentions are key to turning things around with Alibaba include loosening regulatory pressure as well as improved financial fundamentals for Alibaba, which would reflect on things like improving their gross merchandise volume or GMV growth rates, and that's also been slowing down. So across all of these things, we can see that Alibaba has a long way to go before it will financially be performing way better. And some of the steps that Alibaba's management is taking to improve their performance include heavily investing in Taobao Deals and Taocaicai to drive more active consumer spending across various product categories. And it shows in that they've spent 128% more in their capital expenditures or CapEx compared to a year ago, as well as they're especially emphasizing increasing supply and further developing their logistics network, and also increasing cloud capacity. So they said they saw strong demand from the financial services and telecom sectors, and that partially offset some of the slowing demand from some in the internet sector, which includes some online entertainment, gaming, and education. And also talk a little bit more about how they're focusing on growing their cloud business. What I find especially exciting are the massive growth opportunities in cloud for Alibaba, and their management said that industrial digitalization is still in a very early stage, and Alibaba is trying to grow their cloud share by diversifying across non-internet sector industries. So that includes manufacturing, healthcare, and others, in order to be able to get more of a dominant position, as currently they have about 38% of market share in the Chinese cloud market, and they're projecting the cloud market in China to grow by a 5-year CAGR of 37%, and growing from about $32 billion in 2020 to about $154 billion in 2025, and that would be huge. So Alibaba, with its market share of about 38% today, would mean that it grows from only having about $12 to $13 billion of market share to about $60 billion of market share by 2025. And the management had 20% year-on-year growth in cloud revenues, but it would have been higher at 29% year-on-year had it not been for a top cloud customer that I think is a subsidiary of ByteDance, the maker of TikTok. And if it weren't for them not using Alibaba's overseas cloud, they would have had that 29% year-on-year revenue growth in cloud. So it's also an area where they're trying to recover from and probably have a higher growth rate again like they had in the past in cloud revenues. And just to demonstrate how Alibaba is swiftly catching up in cloud market share, we can compare it to the US's top cloud provider, Amazon Web Services, or AWS, which is currently 4 times as big in market share as Alibaba, where Amazon Web Services has about 33% of the US market, equaling about $53 billion out of a total cloud market of $160 billion in the US. And with a 5-year CAGR of 21% in the US cloud market, it's projected that Amazon could reach about $93 billion of cloud market share by 2025. And even though Amazon Web Services is 4 times as big as Alibaba's cloud right now, it would be reduced to only being 1.5 times as big by 2025 if Alibaba continues at a 37% CAGR to grow and become a $60 billion market share in China, compared to AWS having $93 billion market share in the US. And this isn't even including their global market share. So all in all, we could see that Alibaba is growing and catching up quickly to Amazon Web Services. In addition, because a lot of their operating CapEx went into investments in their cloud and logistics fulfillment infrastructure, this is part of why their net cash from operating activities was down by 22% and their free cash flows were down by 26%. But overall, the net cash on their balance sheet remains fairly healthy at 59.5 billion US dollars. So overall, although they're not having as much available cash right now, it's because they're heavily investing in growing their businesses so that they can generate better free cash flows in the future. So I think that hopefully that's a good move for Alibaba. And what's helping buoy Alibaba's share price is their $15 billion share repurchase program, which they're about halfway through, because as the deputy CFO, Toby Xu, who will be taking over the CFO role from Maggie Wu this year, said that our current share price does not fairly reflect the value of our company. So that's why in Q4 2021, they bought back 10 million ADSs, or American Depository Shares, which is equal to $1.4 billion worth. And in the 9 months ending December 2021, they bought back 42 million ADSs, which is equal to about $7.7 billion. So about 51% of the 15 billion that they're going to buy. And that is also helping their stock price to also regain some of the value that it may have lost in the months since the October 2020 decline. And so they're planning on continuing their share buybacks at current price levels while maintaining a strong cash position so that they have the financial flexibility for future investments. And also, I sort of wonder, given geopolitical tensions, if this is why a lot of the large institutional investors on Wall Street are mostly waiting on the sidelines and waiting for the coast to be clear before they pour back a lot of investment dollars into Alibaba, because until the fundamentals picture improves and a lot of the other geopolitical risks also improve, maybe that's holding a lot of investment back from being put back into Baba, because they had a lot of conviction and confidence in Baba before when its stock price hit around $310 at its peak. And so maybe it's just a matter of time before a lot of existing issues get resolved before they have that conviction and confidence in Baba stock again. And also, if we take a look at the super investor activity on Dataroma, we can also see it's a mixed bag, with only 8 super investors adding to their Baba position, while 6 super investors have either been reducing or completely selling out of their Baba position. So overall, generally mixed, and we just hope that Alibaba will figure things out and be able to thrive again. And if you found this video helpful and useful in your further understanding of Alibaba, I'd love if you could please like and subscribe to my video and YouTube channel, because I hope that you can also use this information to better improve your investing process. And I wish you well on your journey as an investor. Till next time.